Ethereum's Dencun upgrade in 2024 reshaped the network, improving efficiency and scalability. But one risk still looms large for institutions: MEV, or maximal extractable value. It's the hidden profit validators earn by reordering or inserting transactions, and for institutions, it's not just a nuisance. It's an operational, reputational, and liquidity risk that must be managed. Why does this matter? Because the scale is significant. By mid-2025, more than $1.8 billion had been extracted across Ethereum, roughly $40 to $60 million each month. The majority comes from arbitrage and sandwich attacks, strategies invisible to end users but costly for funds. For traders, it means annoying front-running. For institutions, it creates performance slippage, divergence between modeled returns and real outcomes, and a silent drain on liquidity. One of the most effective defenses has been optimized routing. Instead of broadcasting transactions to the public mempool, institutions are sending orders through private relays and order flow auctions. Platforms like MEV Blocker and CowSwap have cut sandwich attack risk by as much as 95%. For crypto funds and trading desks, private routing has become a default practice, similar to transaction cost analysis in equities, where execution quality is as important as investment strategy. Private transaction channels are another critical evolution. Much like dark pools in traditional equities, they allow large orders to be bundled securely before hitting the blockchain. By mid-2025, more than half of high-value Ethereum transactions were routed privately. For institutions, this isn't optional anymore. It's table stakes, offering better pricing, less information leakage, and reduced reputational risk. But MEV management isn't only about execution, it's about compliance. Regulators are watching closely. In Europe, policymakers are asking whether private routing conflicts with MiCA's transparency requirements. In the US, the SEC and CFTC are monitoring whether order flow auctions create information asymmetries. Institutions must walk a fine line, protect transactions, but remain transparent to regulators. This is where digital asset consulting partners play a pivotal role, helping clients interpret gray areas and implement solutions without crossing compliance boundaries. So, how are institutions adapting? 3 strategies stand out. First, transaction batching and delayed reveal, concealing order details until confirmation to prevent pre-trade exploitation. Second, MEV-aware custody solutions, where custodians integrate protected routing directly into trade flows. Third, validator partnerships, where allocators align with trusted builders for preferential execution. Together, these strategies echo familiar practices in traditional portfolio management, reducing slippage, managing execution costs, and strengthening governance. And the issue isn't confined to Ethereum. As Layer 2 rollups scale and Alt-L1 networks like Solana and Avalanche attract liquidity, MEV dynamics are appearing across ecosystems. For institutions evaluating altcoins against major cryptocurrencies, MEV risk is becoming part of the performance equation everywhere. The post-Dencun era has shown that MEV risk is measurable, material, and manageable. Institutions that ignore it risk silent slippage eating away at returns. Those that embrace private routing, custody innovation, and validator collaboration can turn MEV awareness into long-term resilience. At Kenson Investments, we help institutions navigate this evolving DeFi landscape with confidence and clarity.